Welcome back, everyone. What a great morning we've had so far. Our next presenter is Goldshore Resources Inc. It trades on the TSXV under the symbol GSHR and on the OTCQB under the symbol GSHRF. And with Wisdom Gold Mines as a large shareholder, is an emerging junior gold development company and owns the Moss Lake Gold Project located in Ontario. Please welcome its CEO, Brett Richards. Welcome, Brett. How you doing today?
Great, Anna. Thanks.
Good. Take it away and call me back when you're ready for some questions.
Super. Good morning, everyone, or afternoon, wherever you are. I appreciate everyone taking the time to hear the presentation. My name is Brett Richards, and I'm the CEO of Goldshore Resources. I draw your attention to the disclaimer slide, and you can view this on our website for all of our any forward-looking statements and disclaimers. And right into it. Goldshore Resources is a fairly new story, and we acquired the Moss Lake project from Wesdome Gold Mines in June of 2021. We listed in June of 2021, and since that time, we have been developing and drilling the property extensively. The Moss Lake project came with a 4 million ounce historic resource, and historic resources aren't built upon. They actually are just a really good guide. You start on a zero base, but it was an excellent guide for us. And we did extensive and detailed geological exploration work at the very front end of this and led to a drill program, which we have. We're about 78,000 meters through a 100,000 meter drill program. As a result of the work we've done so far, we issued a current mineral resource estimate in November of 2022, and that was 4.17 million ounces at 1.1 grams at Moss Lake, which was about a 33% increase from the historic resource at Moss Lake. And the historic resource was broken into two areas, Moss Lake and East Coldstream, two of our target projects. But the real story that's emerging here is the grade. We have 2.2 million ounces at 2 grams. And I'm going to walk you through why that's important. Because when you look at projects, especially mining projects, you look for some very, very simple things. You look for jurisdiction, you look for size and scale and scope and potential, you look for grade, and you also look for infrastructure. So I'm going to walk you through why I think Goldshore Resources is an excellent investment case today. These things always start with people, and the people in our organization have demonstrated that they have success in building mines and building companies and building mines. I have been in this business for over 35 years. I started with a major called Kinross, and I run a number of gold companies globally for that time. Our VP of Exploration, Pete Flindell, he and I had been together for about 15 years on a number of projects, and he and I have built 2 mines together, and I've built 3 in my career. Our CFO, Marlis Yassin, again, extensive mining experience throughout her career. Our board and our advisory board is made up of the who's who in mining, and these are a collection of very, very successful people that we draw on for wisdom, we draw on for guidance, we draw on for navigating through for difficult times, but also seeing opportunities. We have just come through one of the most serious downturns in the capital markets, probably in the past 25 or 30 years, specifically mining equities and gold mining equities. And we've seen very, very difficult times, but we've navigated through it. If you look at our cap structure, we're trading at 25 cents today. We've got a market cap of about $36 million. We have a number of institutional shareholders. The board management own 10% of this. Several people in our company as insiders have participated in every financing, including myself. And we have adequate cash on hand right now. But the story on the trading side of things is where we are. We started out at 65 cents, and because of the very difficult geopolitical and geoeconomic situation in 2022, which led to a tremendous downturn in the capital markets and a risk-off approach, certainly for new projects. we saw our share price fall by more than 60%. But we have one of the most stellar projects in our peer group and in our sector. But we're trading at $9 an ounce today. It actually costs $30 an ounce to find these deposits. So when I look at how we're trading compared to our peer group, we're probably a factor of 2 and 3 and maybe even 4 in some cases behind them. And when we look at the high grade material, we have the 2.2 million ounces at 2 grams. It's trading at $16 an ounce. And you can see how the market gives premiums to high grade projects. And again, when you look at projects, grade is extremely important. These are a number of open pit projects near or in production in Canada, and they're all around 1 gram. So when we display, a 2 gram high grade shear domain that we're going to be focusing on, it's very, very material. So let's talk a little bit about Moss Lake. We are about 100 kilometers west of a major city called Thunder Bay, Ontario. It's in the Great Lakes region, but we're classified as Northwestern Ontario. Our project is on the Trans-Canada Highway, 4-lane highway that goes coast to coast. So as far as infrastructure goes, we have everything on our site. We have access to road, obviously. We have access to international rail. Both CN and CP are on our site. And the most important thing of all is we have access to very inexpensive power. And if you were in northern Quebec or northern Canada or anywhere else in a second or third world country, you would be having diesel power flown in or driven in long distances in order to generate your power. And mining operations, you require a lot of power. So we have the formulation with this large land package we have to build a very, very big district scale mining camp here. This can be the beginning of something extremely special. As we go about our work, we have also heeded to environmental social governments. Our ESG mandate, our ESG policies are extremely important to us. So we have negotiated 2 exploration agreements with our First Nations host communities, and we are continuing to do our environmental baseline study to speed up permitting when that time comes in a year or 2. But looking at the project and the project targets, we have a number of gold targets on our property. So there is substantial room for size and scale and growth down the road. And the projects that I mentioned earlier that are at or near production, some of these projects are multi-billion-dollar CapEx projects. And I just don't think the market is ready for a $2 or $3 billion CapEx project today. So we've decided to break this into little pieces, and we're going to start with a starter project that I think the market can absorb. And where we were driven in the middle of last year, we were driven by data, and the drill results we got at Moss Lake were exceptional. They were market leading. We put out holes last year, 6.3 grams over 56.85 meters, 5 grams over 16 meters. We had several holes that really, what I would say, knocked it out of the park. But we were in the most horrible mining capital markets I've seen in my career. So there is a reset coming. There is a definite reset coming as inflation is still with us. And as the interest rates continue to stay where they are or rise, we're going to see the US dollar start to weaken. And for a number of other reasons on top of that. But the consensus is the US dollar is going to weaken. That is going to keep gold strong. But I think where you're going to get leverage, if you just want a pure gold play, then buy gold. If you want leverage to the gold price, you buy Goldshore. Because the high grade intercepts that we have demonstrated here, this has significant resource potential just even at Moss Lake. And this is one of several targets, as I've showed earlier, Moss Lake being down in this range. And there is an extensive growth target along what we call strike and both laterally. So the gold halos you see here are the low grade material. and the red is the high grade material over 1 gram. So the 2.2 million ounces at 2 grams sits in this red area, and the balance is the lower grade material. And this deposit is subvertical. So this goes down quite deep. We've had some deep holes down 1,000 meters, and the mineralization still exists at depth. So there will be substantial underground growth opportunities down the road. But as I said, we're trying to put together a project that the capital markets will digest. If you can see 11 kilometers away, and if I go back to the original map, you've got Moss Lake down in this area. East Coldstream is up in the northeast along strike to it. We have a very similar geological setting. We have this low-grade halo and these high-grade shear domains contained within it. Our job as explorers and developers is to continue to prove up the size, increase the size of the resource, and also increase the quantity and quality of the resource so it can be relied upon. This was the historic resource that we acquired in 2013, and it was quite substantial. It was about 3.1 million ounces here at Moss Lake, and this is what we've taken it to. And you can see the high-grade shear domains contained within that. So when we modeled this resource, we put a $1,500 gold pit shell constraint on it. Gold's trading close to $1,780 today, but we've used very conservative numbers here, and we've done it for a reason, because all the majors, the Barricks, the Newmonts, the Newcrest, the Kinrosses, the major gold mining companies, they use conservative estimates when estimating resources. So we've used the same estimates. Junior miners will use 16, 17, in some cases $1,800 constraints in order to increase their size and increase their ounces. But in reality, it's just showmanship. And quite frankly, they need a high gold price over $2,000 to support their thesis. Today, we're doing this at $1,500, and it will sensitize down to $1,200. So we're being extremely conservative, but we're also trying to be comparable to the majors when it comes to making those assumptions. You can see what looks like a martini glass here, but it is a cross-section of the pit with the contained resource in it and these high-grade shear domains, which continue to go down at depth. So when I step out a little bit in the project, you can see where the starter project is. There's a couple of starter pits here, maybe 3. We'll increase this. We'll make this a bit greater, but we will be traveling along strike over time because there are a number of mineralized drill holes out in this area. There are a number of mineralized drill holes to the southeast of it, and there's a number of it down here. So when I talk about 4 million ounces today, this is what we have. When I talk about the growth to 10 million ounces, this is where we're going to see it, and down to the southwest and to the southeast of it. So this is going to be the start of a very, very big district scale mining camp. And this is what the major mining companies look for. They don't look for million ounce deposits. They look for 10 million ounce endowments and the potential for more. As we look to move this resource towards like East Coldstream, you're going to see substantial mineral resource estimate updates over the next several years because the endowment is quite large. So when I say, if you want exposure to gold as a hedge against inflation, or do you want leverage to the gold price whereby you can do 10 times money when the gold price goes up 20%? And this is why people invest in gold mining companies. It's why people invest in Goldshore. This is the resource we have. This is what we will be adding on in the coming months. But we did this very inexpensively. We added ounces at $5.75 an ounce. We acquired these ounces for 13 from Moss Lake. So very, very exceptional performance on our drilling from a cost standpoint. And you can see where our high grade sits within our large peer group, all the open pit mining companies in Canada, and where our global resource potential can be. And it's taking this current MRE to the right, making it much larger. And you can see, obviously, the chart is logarithmic. So you can see we we'll be able to move towards that direction. And this is very, very exceptional. When you talk about grade will deliver economics, because what we will plan to do an economic analysis of this in the first half of this year. And it's called a PEA. It's called a preliminary economic analysis. We're now going to wrap a mine plan around that. We're going to build the infrastructure required to mine, to process, to separate, and also to run administratively. We'll build a mining camp, or we'll build offices, etc. Now, all of that is all part of a PEA. So you can understand what the economic outputs are from doing a project. One of the things I haven't even talked about yet, and this is just, I've just been talking about the gold endowment we have, and I've been talking about the potential for that. When you look at our site, we have an area up here called North Coldstream, and there's another area called Vanguard that we're earning into. But when North Coldstream was a historic mine, it made a copper gold concentrate back in the 50s and 60s. It's been completely decommissioned. The mine was completely decommissioned and properly. And you can see the extent of this strike here is 35 kilometers long on our property. But we have these anomalies, North Coldstream and Vanguard, where they look like VMS deposits, or volcanic massive sulfides. And we drilled this earlier this year, and we put out our first hole out of North Coldstream, and we got 62.8 meters at 0.88 copper equivalent with some significant cobalt grades, 0.09%, 0.1%. And this is extremely meaningful, because when we talk about an age of electrification versus and decarbonization, we talk about cobalt, we talk about copper. They are required for infrastructure. They are required for batteries. And this could be a significant development for us. We've modeled where the mine used to be. It was a very small mine, but there's significant potential here that we need to understand and unlock. But for us, the priority is simply Moss Lake. We have to prioritize Moss Lake. We have to get this through a PEA in 2023, so we can all understand what the economic outputs are. So we're continuing drilling. We are doing the metallurgical test work, and metallurgical test work is important so we can understand what the recoveries of gold are based on liberation. So there's a number of ways to do that, and it's based on the geological setting it's in. So we will crush and grind, and in some cases float, in some cases have a gravity circuit, other cases just have a leach process. So we're understanding that right now, and we'll apply all of those results to a mineral resource estimate update that we're going to be doing, and it should be ready for April of this year. And on the back of that, this is when project the phase one, project A starts, where we're going to do a preliminary economic assessment. And that will take us until the end of the summer. But what we're going to see is a project that's going to be around $400 million, not $4 billion. The economic outputs of that are going to be significant. Our all-in sustaining costs will be under $1,000. Our production profile will be around 140 or 50,000 ounces a year. And the free cash flow this generates will be over $140 million a year. And this is the framework that we're working towards. I need to prove all that. That's arm waving right now. I can't prove that, but we have built so many mines in our career. We all know what this is going to look like right now. So, having a $120 million free cash flow PEA, companies like ours trade at 2 times cash flow. That's a $250 million cap company today. We're trading at $35 million today. So rather than just on a per ounce basis, the market can now calibrate us on other metrics from the PEA. They can calibrate us on discounted cash flow. Like I've just said, 2 times cash flow is where development companies tend to trade at. They also trade at, a 0.3 discounted NPV. The NPV of this project will be well north of $700 or $800 million. And I'm very, very comfortable saying that. 0.3 times that's a $250 million cap company. So if you start to look at the metrics of what this project's going to look like, we are significantly undervalued to our peers. We're significantly undervalued to the quality of our own asset. If I just look inside our company, we have a $35 million company with a $250 million potential by September of this year. Now, capital markets willing and investment willing as well, we should be able to deliver on those key catalysts we're going to be presenting, and the ones I show here in this Gantt chart. So we will be delivering a mineral resource estimate to the market. We will deliver the results of a PEA, and then we will do another mineral resource estimate probably by the end of the year or even into 2024. It's not that material because all the focus is going to be on our PEA, because from there we will take this to the next level, a certified feasibility study, so that we can get towards making a construction decision, get into construction financing, get into construction, and actually make this a mine. And I think the strategy to bring in a kind of a phase one approach to this delivers on a lot of metrics. When you look at the projects, you look at the people, and you can quickly determine that we have one of the strongest management and technical groups in our sector. We are in the lowest risk mining jurisdiction in the world. We're in Ontario. 200 million ounces of gold have been taken out of Ontario over the past 150 years. We have 3 key deposits. One we're focusing on, Moss Lake. We also have Hamlin. We also have East Coldstream. We also have multiple copper gold targets in North Coldstream and Vanguard. So there will be significant additions to our resource statement over the next year, over the next 2 years. So the value proposition to the market is quite simple. If you want leverage to the gold price, if you want leverage to even our peers, you look at opportunities like this, because there are very few opportunities to do a 5-bagger, a 10-bagger in 1 or 2 years and deliver substantial value to investors and to shareholders. But this is one of them. And I've been involved with a number of companies. I've had a couple of very big home runs with Katanga Mining and with Avocet, and I think this is the single best opportunity I've had in my career. So I look forward to updating the market along the way, doing a number of conferences this year, and as we do, and speaking engagements as we're doing today. But this is one of the most exciting opportunities you'll see today, but one of the most exciting opportunities you'll see in our sector for some time to come. So, Anna, I'm very happy to take some questions now, if there's any questions from the audience.
Great job, Brett. Yes, we've got some questions for you. So Chris Caldwell says your cash has fallen about $7 million from March through September. Is there any capital risk, or are you able to keep funding the burn?
Yeah, we're able to keep funding the burn. We are very fortunate here in Canada. We have what's called the flow-through market, and it is a tax-efficient mechanism that it's available to us at any time. That money gets spent on the ground, drilling and on the ground at Moss Lake, and the buyer of those, the buyer pays a 15 to 20% premium because there's a tax break for them, and the issuer actually receives the capital a little higher than market. So we have access to that anytime. We'll probably go back to the market early this year. I don't know when we'll go back to the market. We just completed a financing in December. We'll go back. I don't have any issue with there being an overhang or a capital risk. And I think everyone knows that the flow-through market is very, very reliable to us. Starts in January, goes all the way to December.
Great. And Derek Stevenson wants to know if there are any majors producing near you in the Moss Lake region.
Yeah, that's a great question. The Shabanda-1 Greenstone Belt, where we are, and we've got almost all of it locked, the key areas locked up, but it does go for another 50 kilometers. There are a couple of major mining companies to the west of us. Rainy River, which is New Gold, they have an operation to the west of us, and Cote Lake is to the north of us, and that's IM Gold, and they're big open pit, multi-billion-dollar kind of construction projects. But we're only a 4-hour drive to the Timmins camp, where there are over 200 mining companies operating there today. And, again, we're probably 400 or 500 kilometers from Red Lake. So we are centered within a number of big mining camps. And, yes, Barrick are in the Timmins camp. Newmont are in the Timmins camp. We've got Newcrest looking for opportunities today. We've got Yamana, which has gone through a bit of a transition. So we have Goldfields looking for opportunities today. We have Gold Road, an Australian company out in our space looking for opportunities. And these are all multi-billion-dollar companies. But then we have Agnico, and they're on probably 15 projects in Ontario, and a Cisco, and the names go on. Kinross just got the Great Bear deposit. So there's a number of similarities with Great Bear to Moss Lake. So there's a lot of players in and around us.
Great. Marco L wants to know a little bit more about infrastructure. Is there power on the property now? And he understands you have access to it, but is it a significant investment to get there?
I think that the starting point for infrastructure is always power. And I've worked in the Arctic, I've worked in northern Siberia, I've worked in multiple places in Africa where you only have diesel generation power. We have Hydro One, Trans-Canada hydro lines that go along the Trans-Canada Highway on our property. And yes, we have the ability to tap into them. And they're 1,500 MCM lines. We can easily pull down 20, 30, 50 megawatts of power if we need it, but it's available. And this is very key, because if you have to build a road, or if you have to build a road for hydro, you're talking about significant capital, significant upfront CapEx in order to get your project in production. We don't have any of that. We are 100 kilometers to a major port. We're 100 international port. We're 100 kilometers to a major city. So my view is, I think we've got everything in available to build a big district scale mining camp.
Due to time, I want to try to condense some of these questions. Leland asks, the project seems exciting, but give me a timeline. What happens next? And what are some milestones we should look for?
So all mining companies at this kind of development stage, they do take time, and there's no two ways about it. And that's why you get discounted to your economics, because it's more of a discounted cash flow on timing than anything. The next step for us next year will be to do a pre-feasibility study to a point or to a level that we can be definitive, and we can make economic decisions, financing decisions, and a construction decision. And I would look to say, 2025 would be the year that we do all of that, and that we make that decision, and we start. We start with permitting next year, but we start with putting together the project financing for something like this. So realistically, this is not going to be in production until 2026 or 2027, depending on the size and scale that we do. So yeah, we are several years away, but that's not uncommon. And the majors, when they look for stuff like this, they don't really care about the upfront. If somebody wanted to come in and take a run at Goldshore, they don't really care about what we're trading at. What they want is multi-generational deposits, and this Moss Lake will be a mine that will be around for 40 or 50 years because of the size and scale and potential. And that's what the majors look for first and foremost: the size and scale and potential. And then the other things, yes, infrastructure, yes, grade, but the size and scale is what interests them.
Michael Fernandez wants to know, are you financed through 2023?
No, we're not. We will go back to the market in 2023. Not uncommon. We've raised around $60 million in the last 18 months to both support the transaction and to support our development. The market has been very supportive. Even in such a horrible market last year, we still got support. And a lot of that support came from the flow-through market. As I mentioned earlier, it's always available to us. So yeah, we will go back to the market in 2023. And that's not uncommon for junior mining companies to finance every year.
And a follow-up about that topic, Kim Wilkerson asks, what is your cost of funds on the flow-through market if you choose to go that route?
The cost of capital for junior mining companies is it's about 10%. And it sounds very punitive, and it is very punitive, and I hate it, but that's the cost of our capital. And the flow through market is probably a little less, and you do get an uplift on the share price when you do it. And it's available. I don't see a very, very big overhang or very, very big capital risk here. Even, I don't think the geopolitical situation or the macro is going to change in the first, 4 or 5 months of this year. I think it's going to change in the back end. But even in a difficult market, we still have access to capital.
Great. And probably our last question from Lloyd, from a valuation point of view, are you trading at about 5 times cash? Is that correct? And do you know if that is on par with equally positioned resourced companies?
Resource companies at this stage of development don't trade on their own cash because you go back to the markets quite frequently. Mm-hmm. What you trade on is a per ounce basis, and you're trading on what it costs you to find it, and then you're trading on what the potential of size and scale is. Ours is not priced in yet, so there is a big re-ratings, multiple re-ratings to come in 2023 and beyond, simply because we are not trading at a valuation even close to our peers or even close to what the cost of that capital is. And when I talked about a PEA real quickly, I talked about a PEA. When we get that done and we get that to the market in September, it will give the market 2 or 3 other valuation metrics to value us on. One being free cash flow, discounted free cash flow, as I said, and the other being kind of a discounted NPV or net present value. There are others as well, but those are the 2 key ones.
Great. Well, fantastic presentation. And thank you for your thorough answers through this Q&A. We really hope that you come back in the future with some updates. And thank you so much for joining us, Brett.
Anna, thanks for having me. And thanks, everyone.
All right. Thank you so much. Stay with us, everyone. We'll be right back with our next presenter.